All right, let's not waste any time.
I think that was unfair to you, by the way.
You think so?
Yeah, I think you have a kind of a Zen, calm capacity.
Well, you're a close watcher of the show, then. Yeah. Clearly. All right. 3 years ago to the day, you heard Tyler Masson say it. We thought we were past all this. You also had integrated a TARP program that, in retrospect, was incredibly successful. You put through a stress test that many of us were, let's say, critical of initially. Turns out to be a huge success. Why are we back again in the same problem? And why haven't they used your blueprint to solve it?
Well, if you think about the basic lessons of financial crisis, it takes a certain number of things to solve them definitively. First of all, you have to have a clear, unequivocal, unified commitment to do whatever it takes to solve it. You have to be open and honest and transparent about the scale of the challenge. Make sure that investors around the world have the capacity to make judgments to differentiate across institutions and have an incentive to provide the funding you need for economies to function. And you have to use overwhelming force. And what we ultimately did, the U.S., of course, was behind the curve early, too. But what we ultimately did is put politics aside, and you had an incoming president, outgoing president from vastly different traditions in the American political system stand together, and you had a central bank and a finance ministry working very closely together to do whatever was necessary. And it was that combination of actions that ultimately was decisive for us. Although, as a country, even with the remarkable success of that early stage of the financial rescue, we have a lot of challenges ahead, very difficult challenges ahead, and we're still living with the scars of that crisis.
All right, well, where are we? I mean, what inning are we in versus what inning are they in?
I think, let me just start with the U.S. Obviously, we have weaker growth than we thought, weaker growth than we'd hoped. Why is that? It's the combination of three things. You have an economy that's still healing, bringing down debt, working through the big imbalances that caused the crisis. That necessarily leaves growth weaker than you would like, more vulnerable than you would like. Mm-hmm. Then you had a bunch of very substantial adverse shocks, high oil prices, catastrophe in Japan, the trauma in Europe, combined with ongoing fiscal drag at state and local governments. That weakened growth really quite substantially. And then you've had this terribly damaging political dysfunction here and in Europe that leaves the world wondering whether political systems have the capacity to do the right thing. And that is very damaging to confidence. It's been devastating to confidence in the United States, and it magnifies all the challenges we have. Ultimately, what you have to do is you have to put the economy ahead of politics, and you have to put the imperatives of growth, not just immediate growth, but long-term growth fundamentals ahead of political considerations and all the other objectives we face as a country, and that's what we're trying to do.
Is this what you're going to say to them? You're going back a second time, which worries me. Our viewers are very fearful. You're going back to Europe. You're going to speak one-on-one with the major ministers. Are you going to tell them that they have to understand there must be political will, they must put firepower together, that what you've heard so far is not enough to get us out of this crisis?
Well, Jim, they invited me to come. I thought it would be polite to accept that.
All right.
Obviously, they're going to want to talk about the United States, but they're going to want to talk about Europe, too. And we have a huge interest as a country in them solving this. Now, a few things about Europe, because that's obviously such a dominant concern now. What they're doing is very challenging. They're trying to figure out how to build the architecture of a more complete fiscal, financial, monetary union. They're trying to help countries in terrible crisis implement a set of reforms that can allow them to get to fix a set of problems that took decades to build up. And they have a terrible growth problem, and they're trying to solve all those problems at once. And I think it's important, as you saw the Chancellor of Germany say yesterday, Angela Merkel said yesterday, they are absolutely committed, and they have the financial capacity, the economic capacity to do what it takes to hold this thing together. I think they recognize that they're going to have to do more. They recognize they've been behind the curve. They recognize it's going to take more force behind their commitments to make sure that Italy and Spain can fund its sustainable interest rates, that the countries undertaking these reforms in Greece and Ireland and Portugal have the financial support they need, and most importantly, that they make it clear, and of course they have the capacity to do this, that they will stand behind their financial system so that their system can fund and therefore finance recovery in those cases. Those are the three things you have to do. I think they recognize that how severe the challenges are right now, and I think they recognize that they're going to have to do more to earn the confidence of the world that they that they have the political will to do this.
Two banks last night needed more than $500 million in U.S. dollars in order to be able to meet funding needs. Now, I know the European markets are up, so I have to believe that there is some sense that this is not a problem. Do they have a plan for dominoes? Do they have a Citigroup plan? Do they have a Washington Mutual shotgun plan? Do they have an AIG plan? And do they have a must-never-have a Lehman plan?
Well, think about Europe. I mean, Europe has a tradition of much more indulgence, support for their institutions. Their institutions are much closer to ours, to their governments. There is, in just one man's view, there is no chance that the major countries of Europe will let their institutions be at risk in the eyes of the market. There is not a chance.
Take off the table Lehman.
Of course not. There's not a chance. In fact, I remember the Chancellor of Germany saying to the President of the United States repeatedly in private meetings, but she says this in public, she says, we are not going to have a Lehman Brothers. We are not going to do it. And obviously I think she recognizes that they've got to do some more to make sure that they make that commitment credible to the world.
What are the exposure here? We hear about our money funds. Viewers call me to say, listen, we're very worried that our money funds are in jeopardy because of investments they've made in French banks. Derivatives. Do we really know, even after Dodd-Frank, what our derivative exposure is to our banks? Borrowed monies against subprime debt. Did anyone here do that? And do we even have the ability to know what our banks are doing over in Europe?
I think it's important to think about this as overwhelmingly a European challenge. Now, it matters to us because it adds to lack of confidence, concerns about risk across the. It makes everybody more tentative. You know, think about us. We just went through this terribly damaging debate about default in the United States. You know, people, elected leaders of the United States, were talking openly about the merits of default, threatening default, saying it might be a desirable path for the country to go through. When you ask people to contemplate the unthinkable like that, it makes them more scared, more tentative. And so Europe matters to us mostly because it adds to a sense of caution around the world at a time when we're still healing from the crisis. But our financial system is because of the actions we took early in the crisis, is in a much stronger position to deal with these new risks in the world than it was before this crisis. Much, much stronger position. Way ahead of the rest of the world in trying to make sure they have a stronger financial foundation to handle any type of shock. Still, we have a big interest as a country in helping Europe get through this, and we're going to do everything we can to help them, make it easier for them, and support them.
Could their banks pass your stress tests?
You know, I think that's a question you should ask the broader investor community. I mean, what we tried to do in the United States was lay out enough detailed information with a very tough set of assumptions so the world could make their own judgment. The world could decide, were our assumptions tough enough or not? And you could make your own judgment. And that's ultimately what turned things here in the United States. That combined with the fact that we forced people to go raise enough capital to cover those losses.
Journal today, emerging giants look at Europe aid. Do we need concentrated worldwide aid to help Europe, including U.S. money, money from Brazil, money from China? Is that on the agenda?
Well, obviously, this is a big enough thing to matter for the rest of the world, and the rest of the world has a big stake in helping Europe through this. And you've seen us support really exceptionally forceful action by the IMF, well beyond what they've ever done for other countries around the world. And that's a reflection of our stake. And, of course, the Federal Reserve appropriately is willing to be as supportive as possible in helping the ECB and the other national central banks meet the dollar funding needs of those countries. And, again, as I said, we have a big interest in helping them through this. But this is their challenge, and they have the economic and the financial capacity to meet this challenge. The people who are concerned that this is beyond their grasp are mistaken. The size of the challenges they face financially, economically, are completely within the capacity of the stronger European members to manage.
That's great. I got to tell you, that's great, because people in this room and people at home are petrified that's not the case. So that's terrific. I'm taking that off the table. Now let's talk about the fact that you said the economy's weak. You put out a jobs plan. New York Times today basically gives it its obituary. Tax plan for jobs bill, familiar ring, meaning the GOP will not back this. Is this dead on arrival?
Absolutely not. And I think that there's no reason now for the Congress of the United States not to act to help strengthen growth in the near term. It's the conservative, prudent, responsible thing to do. You can think of it as protection against Europe.
Okay.
You can think of it as insurance against weaker growth going forward. And you got to think about the alternatives. If Congress or Washington is incapable of acting, then policy will be damaging to growth, because what you'll have is a deeper, steeper contraction in fiscal support than is prudent for economy at this early stage of the crisis, given the shocks we face as all. So, life's about choices.
Right.
Life's about alternatives. And what we have done is our president's put together a package which we think has a very powerful mix of tax incentives and investment that would be good for job creation and the economy right now. And we're proposing to make sure that ways to make sure it doesn't add to long-term deficits. And people will have different views about what's good for growth. And I haven't heard them, but if people got a better idea, would it have the same impact on growth in the short term? Of course we'd be open to that. Haven't heard it yet.
All right.
And if they got a better idea for paying for this over 10 years, it's not going to damage long-term growth, other things that matter to us as a country, then we'd be open to that too. But the key things...
National energy policy. We've got perhaps 200 years worth of natural gas in this country. We know that the states that have great employment that actually are looking for workers. I was out in North Dakota a couple of weeks ago. They're looking for workers. Why not get behind a plan, a bridge plan, to be able to put together maybe a package to put 2 million people to work to make this country energy independent with the possibility of cleaner skies, and make it right here, right now, because that's working. Instead of trying to cut the allowances that you're doing for oil and gas, which will cut back the one industry that's putting people to work in this country.
I don't think there's much risk of that, and there may be merit in your thing too. As I said, we're open to anything. The basic imperative people in Washington face today, and this is the basic lesson of financial crisis, is you have to keep at it.
Okay.
You have to keep at it. You say that we are going to continue to do whatever we think it'll help get more people back to work, make the economy strong in the short term, until we get definitively through this. And our basic strategy is to make sure we are healing the damage caused by this crisis, and we've got some ways to go, as you know, despite the improvement in the financial sector. And we want to make sure at the same time we're making this a better place to invest, make exports stronger, and strengthen our long-term fundamentals. And that requires making some tough choices about the long-term fiscal.
But you have been saying to people both in private and then publicly in these interviews you've been giving, listen, don't overweight inflation. I think that Trichet is overweighting inflation. Here, though, in some of this plan, you would be doing a deduction that would make it so the housing crisis could be worse because of the mortgage problem.
I don't think that's quite fair. But what Jim's referring to is the following. We have proposed as one way to pay for what the economy needs now is that over 10 years we start to limit some of the deductions that Americans enjoy, some of the, no doubt, hardest working but most fortunate Americans enjoy. Now, why is that good policy? You have to look at alternatives again. Okay. Our judgment is, and people can disagree about it, our judgment is that mix of modest changes to the generosity of deductions for a small fraction of Americans has the least risk to growth, least risk to recovery, least damage to the kind of incentives for investment we face going forward. Now, this is not perfect science. Some people may disagree. That's our judgment. That's why I say that if people have a better way over time to make sure that as we invest in things that matter now, we're not adding to our long-term deficits, we'd be open to that. But we think this is a pretty good mix.
Carried interest, is this really an important issue? Why are these people who are making billions being paid in capital gains when the rest of us are being paid in ordinary income?
Again, nobody likes to see taxes change, their taxes go up. And there are no options on the table that are going to be attractive to everybody on the tax front. We have to make judgments about how we live within our means as a country, how we do it so in a way that's more fair over time. And as part of that, as I said, we think it makes sense to make modest changes in the current tax benefits that go to a relatively small fraction of Americans. Now, if you don't do that, you have to do one of three things. You have to decide you're going to borrow the money to sustain those. We can't do that. You have to decide you're going to raise somebody else's taxes. You're going to raise taxes on 98% of other working Americans. That's a hard thing to justify doing given the pressures are under. Or you have to decide you're going to try and cut more deeply into basic benefits that middle-class Americans depend on. And although we think there's a lot of tough things we're going to have to do on healthcare benefits, other broad functions of the government, there are limits to what we can do that without being fundamentally unfair or without undermining core things this government needs to do to make sure we grow in the future. So we're trying to make those choices, and we're going to have a good debate about those choices, and I think it's a debate the country has to have.
Okay, now, Mad Money, why not? Lightning round? Let's do one. Come on. I mean, you're a frequent caller in the lightning round. We've not taken your call, but you're frequent. All right. You just mentioned that you're not positive to borrow. I once asked you, point blank, look, why not do a 10-year? 10-year gigantic $200 billion. Lock down that financing. Make sure that we have no liquidity problems ever like Europe.
Yes.
You told me it was
Yes. We're following your advice.
You are?
Yeah. We are doing the prudent economic thing right now, which is we're borrowing roughly 10%, at roughly 2% for 10-year money. It makes sense for us to invest now, as long as we do so in a way that doesn't add to our long-term deficit.
But why not do $200 billion, something bolder? How about a $200 billion?
As you know, the package is $450 billion spread over 18 months to 2 years. It is a very substantial package. Range of economists that will add 1 or 2 percentage points to GDP growth. I think that's realistic. Depends what Congress ultimately does, but yes.
Okay.
What you said
that was
right.
different from what you told me a year ago.
It's good. What you're saying is good economics,
yeah.
And it makes sense now, again, because human economy is still healing from crisis. A bunch of things happened to us that caused growth to be weaker. A lot of self-inflicted damage to confidence caused by the debt crisis. The responsible thing for government to do now is find ways to help growth in the near term.
Okay. Take advantage of the low rates. Make people refinance. Fannie and Freddie own 60% of the homes.
Yes. We're
How are you going to do it? Just going to... I'll take yes for an answer on this one. You know what?
Well, right now we haven't. Rates came down a lot. Mortgage rates came down in part because of a range of things we did and the Fed did. That's good policy. Try to help protect the economy from the risk you have further avoidable pressure on housing prices across the country. But for that to have its maximum effect, you want people to be able to refinance. There's a range of things that people in this room know very well that get in the way of that. We're trying to reduce those frictions. Those lie within the authority of the FHFA. But they, as you've heard them say, are very open to trying to fix those constraints so that you could see a substantial additional number of Americans, even people who are underwater now, refinance to take advantage of lower rates.
Okay. Oil prices. You mentioned them as a principal impediment to be able to get some growth here. Oil is too high versus the slowing of economies. Is it possible that we could have an investigation to find out whether oil is being carteled by hedge funds? Rates are making it so that oil is being hoarded, and that's why it's too high.
My own view of this is that oil is fundamentally driven by fundamentals, that there are periods when financial activity can amplify what's happening in oil prices. But I think mostly it's been fundamental driven, and you've seen them come back quite a ways from the peaks earlier in the year, and I think that'll be helpful because that'll sort of ease the pressures.
But West Texas is much more than the price off. Americans pay off of Brent. Is that wrong?
I think, anyway, I'll say it this way. Prices have come down now to the point where they're much less likely to be a constraint on growth and much less likely to force, let's say, constrain the activities of central banks around the world.
Should we outlaw credit default swaps on things that we do not own?
Absolutely not.
Why?
Because I think a lot of debate about this, of course, a lot of ambivalence, I can fear about it. But what you don't want to do is get in the way of the market's ability to hedge against risk. If you do that, you'll have people take less risk. That's bad for growth, bad for investment, bad for economic activity. Now, that comes with risks, of course, okay, and comes with challenges for the system like we saw. But the best way to deal with those challenges are to make sure the system has enough capital against risk. So the guys that are writing that protection hold enough capital against the commitments they make. If you do that, you can successfully mitigate all the concerns people have about, not all, but most of the concerns people have about all types of innovative financial instruments.
I speak to many CEOs on my show. They all have billions of dollars overseas. They want to bring it back. They want to create jobs. They want incentives. Will you pledge to change the repatriation tax laws to get that money back in?
In the context of comprehensive tax reform, corporate tax reform, that lowers the statutory rate and broadens the base, which the President of the United States is committed to do, then we will you'll see us propose ways to strengthen incentives to bring that money back. But we are not going to do that, repatriation outside of corporate tax reform, because for the simple reason that it costs a lot of money. It costs between $20 and $80 billion to do that over 10 years. And if you're going to do that, you've got to figure out how to pay for it. And how are you going to raise taxes on the 96% of companies across the country that don't benefit from repatriation? How do you make it fair to them to raise their taxes to pay for that? So in the context of corporate tax reform, we think we can do a lot of things, including this, to help improve the incentives for investing in this country. Remember, the long-term growth prospects of the United States depend overwhelmingly on one thing, which is making sure that we improve the incentives to build and create more things in this country and export them to meet the huge demand you're going to see over the next decades from China, India, Brazil, all those countries around the world. And we are much better positioned than all the other major economies to benefit from that long boom in emerging markets. Much better position, much more diversified strength across things that those countries need. And what we want to do is to make sure that tax policy, regulatory policy, education, infrastructure all work together to reinforce a strategy that makes it more compelling to invest and build and create things in this country to meet that growing demand.
If you were on the super committee, would you say, listen, let's just go with Simpson Bowles? It made sense. It's been dropped. It's time.
I think the best models out there for our long-term fiscal reform look like Simpson Bowles. They look like what the president laid out in April. They look like what the Gang of Six laid out a few months ago. And you'll see the president propose on Monday a very detailed, comprehensive, and balanced set of reforms on long-term spending across the government, and tax reforms that help contribute to deficit reduction, but do so in a way we think is which is fair. So I think all the credible models for fiscal reform lie in that universe of proposals.
Okay. Trade deals. It looks like to the American people...
Yes, we're for them.
Well, how about ones that actually make it so that they have to buy our cars? They have to buy our stuff. We buy everything that they want. Why don't they have to buy our stuff?
That's why we should do it. Look, what if we don't do trade agreements with countries like Korea? Just take an example. What happens? Then other countries come and take market share away from U.S. companies. If we sit there and do nothing, we lose market share. Opportunities for American companies for stuff built here are disadvantaged, eroded over time. And we believe, of course, we felt this early in the summer too, but I think we're more confident now that we have Republican and Democrat agreement for a strategy to get these three bills passed, Korea, Colombia, and Panama. And those are important on their own because they're good agreements on your test. But more important than that, they give us a chance now to go out and negotiate with the rest of the world and try and do things that have even better bang for the buck for American companies. And that's because when we demonstrate we can legislate agreements, then countries around the world will have an incentive to negotiate with us. Until we demonstrate we can legislate them, they have no incentive to negotiate with us. We're trying to change that.
3 years from now, euro, alive, dead, meaningful?
Absolutely alive.
Absolutely alive.
Yeah, I think, again, listen to it's not my judgment to make, listen to the Europeans. You know, they committed a generation of political capital to building that institution of Europe.
Okay.
Now, it was incomplete on the financial system, on fiscal policy, budget policy. As you've seen, they did not build that mechanism, but they're doing it now. And they're moving. I know it feels a little slower than the markets are moving, and they got to move more quickly, but they have done in just 18 months a lot to compensate for those gaps in the initial framework. They got some ways to go, but they're moving. They're moving to do it. And I think they've committed to do it. They're all in. They're going to have to do whatever it takes.
Greece, must it be saved, and must the Germans do it?
Well, again, to solve a financial crisis, you need reforms that, fix your financial system, in their case, shrink their government, make growth better over time. It takes time, and it does not work unless it's supported with money. Okay. There's just no way it works. You can't expect anything to happen without giving them the capacity, the breathing space to be able to borrow. All
right, finally, on Friday, 9/11, we had a memorial on the stock exchange. Paul O'Neill was there, Treasury Secretary. Treasury Secretary told me, you know why we don't have any real change in this country? Because when you speak your mind, as I did as Treasury Secretary, and say, you know what, we got to pay for all that we're doing. Eventually we have to have tax increases. Boom, you're fired. And that's why nothing changes. People are afraid of getting fired. Are you afraid of getting fired?
I've been hoping sometime, but I'll tell you one thing. One thing, Jim. As you said at the beginning, you're gracious. At the beginning, I've never done anything else. I spent my life in public service, mostly in the financial side, and I have never been in the position where I had to say something I didn't believe, and was not given the chance to fight for what I thought was right. And I completely agree that I think the test of holding public office is a willingness to be open about the challenges and to be fair and clear and candid, direct about the kind of things you have to do. And I've always tried to, not perfect, but I've always tried to do that.
But you are someone who has never believed in a profligate government. You are someone who has a long history of being, at least when it comes to banks, saying you cannot lend more than you have.
I'm a fiscal hawk, and I'm a big hawk on capital, bank capital. And I believe everything we've tried to do to put out this financial fire and start to build a better foundation for the long term is consistent with that. You know, remember, to put out a financial fire, you have to do things you would never want to do in normal times. You have to do exceptional things, really difficult things, things people hate. But there's no alternative. I mean, you're seeing a natural experiment in the alternative now. How does that look? How does that feel? And ultimately, and this is the paradox of thinking about policy in a crisis, is the stuff you have to do to make long-term fiscal deficits more healthy requires spending money now. There's no alternative. If we'd sat there in that crisis in the fall of 2008, in early 2009, and did nothing, debated what was cool and optimal, if the president had not willing to take enormous political risk, then you would have done terrible damage, not just to the economy and the fabric of business across the country, but you've done terrible damage to our long-term fiscal position. So I'm very comfortable that if you're a fiscal conservative, you're a fiscal hawk, you understand our long-term debt are unsustainable, you have to be willing right now to make sure you're doing stuff that helps heal the economy as we recover.
All right, last lightning round question. If you do not get your jobs program passed, does it increase dramatically the chances of a recession in 2012?
If we do not pass a package this large and this powerful, then economic growth in the United States will be weaker. No doubt about it.
But does that mean a recession? Is a recession in your realm of odds? Do you tell the president, look, we are this close to recession. We must get this done?
Well, let me say a little more carefully. If you look at the average of private economists, and they think about the outlook for growth in the United States over the next 18 months or so, I think they're largely in the 2% range now. 2% is just below potential growth in the United States. Growth should be stronger for an economy coming out of it. It can't be 5%, but it should be stronger than that. And what this package will do is not just buy some protection from the trauma you see in other parts of the world, not just buy some insurance against the risks that, other things could happen to weaken growth, but it'll make the economy stronger in the near term. And that's good, prudent policy now, as long as you combine it with things that make sure the long term is better.
But there are people committed in Washington to stopping your plan, saying that it's going to tax the job creators, and they want this thing dead before it gets started.
Well, again, you have to look at the merits of these things. This package is a mix of tax changes that have had broad-based support across the American political system, not just for years, but for weeks and months. And it has a commitment to make sure as we do those things, they don't add to long-term deficits. Now, people may have a better mix. If they have a better mix for growth, then we should look at it. Haven't seen it. And if they've got a better way to pay for the long-term stuff, we'd be open to that too. But the test of governing should be, what's your plan? What's your strategy? And most of the alternatives you hear today are political strategy, not a growth strategy. Most of the alternatives you hear today are about magical thinking, about well, I won't say it, but the test should be what's going to be good for growth.
Okay. Mr. Treasury Secretary, thank you for your candor, and thank you for pledging and telling us no more Lehmans. Good to see you, sir. Thank you. Thank you very much.